Good afternoon, everybody, and welcome to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, and joined, as always, by my good friend and colleague, Todd Anderson. How are you doing, Todd?
I'm well, Peter. How are you?
Doing great. And joining us for the first time today, delighted to welcome Andrew from Activant. How are you doing, Andrew?
Very well. Thank you both for having me on today.
Of course. Thank you.
Yes, thank you. So before we get started, why don't you just give a little intro about yourself and Activant?
Wonderful. So I'm Andrew. I'm at Activant Capital. I'm a partner here in the investment team. We're a growth equity fund, so we're focused really on sort of Series B through Series D, but we're really thesis-driven firm, so focusing a lot on commerce enablement, which inevitably is really heavily focused on fintech. Payments and financial services are the greatest enabler of commerce, so spend a lot of time in financial services as a whole and lead a lot of our fintech work here. We're based in New York, typically writing $20 to $40 million lead checks, and we have offices in Europe and in South Africa.
Okay, great. Well, we will now kick it off. We got another busy week of news to cover. First off, we're going to start off with some bad news. We've had some more layoffs. Two of the biggest fintech companies in this country have announced rounds of layoffs. First we had Stripe announcing 14% of their staff, which is more than 1,000 people. They are really a sizable company these days. Going back down to 7,000 people at Stripe, and then Chime cut 12% of its staff, which was 160 people. And so that's sort of this news, I think, came out yesterday, and it's not a surprise because pretty much everyone has been cutting back, but still not good news to see the biggest companies kicking off like this.
Yeah, it's a bad signal in the market. Not surprising though. I mean, everyone's kind of bracing for what's coming in 23. I'd be curious if what's coming in 23 isn't as bad as everyone's predicting. Will these companies kind of hire back up a bit, or will they kind of stay at this level just to be safe for the next couple of years? I mean, even you heard Amazon today talk about, I think it was leadership or executive teams that they were going to slow hiring there and kind of stay steady for at least a little while and kind of wait out where the market is. Unfortunate, but not overly surprising news.
Mm-hmm.
Yeah, I would agree. I think it's, for a lot of folks, it's controlling your own destiny is the key thing. Even for the biggest companies, just making sure they're flexible going into the next few years because there is a lot of uncertainty. It's difficult. It's a really tough time for a lot of people, but I think it's important to control your own destiny as founders and leaders of these companies.
Right, and that's why, I mean, both Stripe and Chime said that they are well capitalized, but want to conserve capital because the future is uncertain. There's lots of probably more uncertainty right now than there's been in a long time, and obviously they want to make it so they can get through with some capital padding, shall we say?
Yep.
Okay. Next up, Coinbase, and there's been a lawsuit between Ripple and the SEC for some time. We've covered it here on the show, and it's Coinbase has been supportive of this lawsuit, but now they've gone and filed an amicus brief with the court, basically making their support official. They've highlighted how the SEC has not given fair notice on some of their enforcement actions. They've been inconsistent, and I think most people in crypto would agree with those statements. Maybe all of fintech, for that matter. But because the fact is, they're like they claim that these tokens are securities, but Ripple's been singled out. There's plenty of other companies like that haven't been singled out. So it's the big guns are coming out, and the SEC hopefully will not prevail, and hopefully we'll see some actually clarity coming.
Doesn't this come off the back of that IG report out of the SEC that basically gave them quite the scathing
Right.
review saying that lots of people inside like they weren't aligned across the SEC, and this it's not surprising that Coinbase would choose this time versus another time right after that report
Right.
to do it. It seems to be piling on a bit. I think overall, I think where the SEC has probably gone most wrong is just being equal across the board to the companies. If you're going to be stringent, then just be stringent.
Mhm.
But it seems at this stage they've kind of picked some companies here, some companies there, and have kind of been very uneven to the market. And I think Coinbase is trying to push them in the direction of, hey, let's just get an equal chance, even if it's more stringent than we want. Just give us all the same playing field.
Mhm.
Yeah, I totally agree. I think just clarity is key for everyone who's building, because as a finder, you're investing your time, like years of your time in building something, and having clarity is like mission critical to knowing where to take the product, where to go next. I think it's also just interesting though that like this topic, really relates to like the utility versus like what is the intent of crypto? What is the intent of all of these tokens? What is the intent of what we're trying to achieve? Is it really around sort of value creation from a, functional use case, or is it from a sort of speculative use case? And I think as we see the market turning, a lot of these things come into focus, right? Whether it's with Robinhood in the pandemic, or whether it's today in this market, I think we're just going to see a bit more scrutiny as consumers, are hurt potentially, whether it's their fault or not, right? Coinbase and everybody else has sort of felt that, right?
Right.
With consumers like not sticking around the platform quite as much potentially.
Yeah, well, that's the thing. You look at any of these companies, their earnings are down because there's less activity on their platforms, because people have moved on to another thing, or they're just not. They might have just not trading as much, and that's these companies rely on trading revenue,
especially the crypto companies where there's still fairly high fees.
Yes,
I mean the Robinhoods of the world, at least they're doing the payment for order flow, making the money on the back end, but
right.
a lot of the crypto companies are still relying on the fees, at least today. Obviously that'll compress over time, but they need that volume of people on the platform.
But it does feel like the natural like evolution, right? Like if we want to see crypto really break into mainstream finance and really have meaningful impacts and workflow and everything else that we all hope it will in the future, I think we need to solidify some of this stuff. We need to like clarify some of this stuff early so that we're able to like really build over the next few years. So I think, I don't know. So it's always tricky and no one likes to be singled out, but I do think that steps forward here are going to be positive for the industry as a whole.
Right. Eventually we'll get clarity. We just don't know.
Yeah, exactly.
Eventually.
It's going to take a while, possibly.
Speaking of taking a while.
Yeah, speaking of taking a while, we are now. There was an article about Custodia Bank's lawsuit against the Federal Reserve. This was filed over the summer, and it's now there is some movement. So last Friday, a judge heard oral arguments from Custodia, from the Fed board, and the Federal Reserve Bank of Kansas City, which is under the jurisdiction of for Custodia in Wyoming. The judge was actually not that complimentary towards the Fed, saying, it's been like 2 years since they've put this application in with no. And the thing that's frustrating, we've heard, Caitlin Long, the founder and CEO of Custodia, talk, at length about this. There's again, talk about clarity. They don't even know what the holdup is. They've just sort of been rebuffed and not really clear about what's happening. So the judge is going to have a final decision, he says, quickly. We don't know exactly what that means, but given that how things have been going, I don't think it's going to be weeks. I think it's going to be coming fairly soon.
But there's kind of two things here. One, he threw the Fed under the bus, saying that with all that smart people,
yes,
and all that brain power, like, why is it taking you so long? But at the same time, he did mention like those legal technicalities of like where the Fed sits and the different Fed board of governors and like their private entities versus the Fed overall, and kind of those. So it seems like he was kind of splitting hairs a bit and might be signaling like, hey, I'm on your side, but there might be no legal path for me here. I don't know. That's how I kind of read it. Like he wants to side with Custodia, but he did mention that those legal technicalities, which makes me think that maybe they're gonna fall under that, and it's essentially a technicality that gives the Fed the win. But hopefully they can continue on, because I'd like to see something like this go to trial just to see where it ends up.
Well, I don't know if you're going to find a jury that can actually understand
any of this.
Jury of their peers. It's going to be. There's probably only about if you go into the crypto community, you could find lots of people, I guess.
Yeah.
Certainly, it would not be an easy jury trial, because it's quite complex, and I don't even know. I mean, I don't know if it's going to go to that. I mean, there was another article I think earlier in the week as well that said the Fed's in a no-win situation here. They've basically eventually they've got to do something, whether or not they are they don't want to feel pushed. So if they come out and approve now, everyone's gonna think, well, it worked. Custodia sued the Fed and it worked. So more to be told there. We'll keep an eye on that one, because we're big fans of Caitlin Long and what she's been doing. So, okay, moving on to one of our stories this week. This was a really interesting one from about the Credit Suisse debacle. This happened like over a month ago. But this was a piece that Isabel Castro wrote from our team, just really going back and digging into it and talking about, what basically, let's back up and explain what happened briefly. So, Credit Suisse was having some issues. The people on Twitter were saying they're going out of business. It's going to be another Lehman Brothers, and it ended up not being that, but it just their stock crashed based on the Twitterati kind of going in. It's like an anti-meme stock type thing. People were piling in on how bad it is, and it wasn't. I mean, we don't know exactly what was going on, but there's obviously Credit Suisse is still around, and they're coming through this, but it just made a point that this can come to fintech as well, because if the Twitterati suddenly decide your fintech company is not worthy of trust, then the same thing could happen.
Yeah, this one's go ahead, Andrew.
No, it's fascinating. It's fascinating how quickly things can turn. I mean, I tend to invest in B2B infrastructure companies mostly, but now and again we do some consumer. And it is one of those things you think about as an investor in earlier stage companies, is they can take off based on sort of momentum within communities, momentum within like power users, and they can also go the opposite direction. We don't see that happen as much, but it is. I think this idea of trust in financial services is interesting, because there's multiple layers to this. Like, I don't think previously people were talking as much about their financial lives just generally in public, and then you're watching sort of Twitter and financial forums completely take companies down, like financial businesses. It's a funky sort of setup, but like, I mean, there's a couple of ways that I think when I first was reading this article, it was actually interesting. I was thinking a little bit about like fintech public companies, or companies that were like the hot fintechs, and like how would consumers react to them as actual users of these solutions, and like would they actually try to like take down some major stock, a Lemonade in insurance, or whoever it might be that goes public next? Or is it actually more about sort of like actually building momentum in a negative way within the community of a sort of private fintech, like actually, because in the actual community itself, because some of these apps are quite social in nature, right? We're starting to see the trading apps come out. The next generation of the Robinhoods is actually, hey, I'm going to share my stock trading portfolio, and you're going to build some ETF around it. And it creates a lot of momentum, but it does create these fears that like you could have what happens to a hot social network happen to a financial services app. And I guess that's kind of the end state of a lot of fintech and embedded fintech, is like we can embed financial services in everything. So if we're going to do that, and we're going to bring it to more social driven applications, we're going to probably keep seeing this more and more, right? Fintech applications that are really social apps dropping off faster than we've ever seen. So I don't know, it's a really multifaceted point. in that article. Thought it was really good.
Yep.
Yeah, one of those companies is Common Stock, who I recently had the CEO on the podcast. We talked about the social aspect and how that can jump so wildly, so quickly. And I think there's such a vitriol at time on social too. It's like you felt it reading the article, like how mad people were getting that I was right or I was right, or it's and the one thing I left the article with is no matter what, fintech still has a high bar to reach, and they're not there yet.
No.
No matter how good some of the apps have been, how great they've been for inclusion and ease of use and little friction, um, their bar is super high to get their trust, and it's going to take a lot of time.
Yep. Yep.
And people are more they scrutinize more than ever because they see things more transparently. So I mean, we'll talk about this more with the Plaid article and what they were talking about in terms of trust with consumers. But it's funny to see. I saw a chart recently about which fintech apps earn the most per user per month or per year, and like Cash App is very, very high, and
Right.
a lot of that is coming from those fees in dispersing funds from the app itself. And what's really interesting is like trying to understand the business models of these companies and the value that they do actually give to the end consumer versus how that cost is perceived. Because to some degree, you could probably argue that that's not that dissimilar of a feeling than getting some kind of fee in my existing bank account, the kind of stuff that we're really, really, we have visceral reactions to when it comes to regular banks. But we get a lot of value from Cash App. It's social. We all agree that it's great. So then consumers are fine with it up until the day they're not. And someone decides that this is horrible. You're all being duped. Like you've been charged all this money that you shouldn't have been charged. But that's the business model. So I don't know. I just think generally you see this evolution where whether it's interchange that then leads to software services or whatever it is, people eventually want to feel like they're being charged and they're making the decision to be charged, not being charged without them really realizing it was and thinking it was free, and then being told that it isn't free by someone else on the internet, and then feeling that they were fooled, which is kind of what you see over and over again with this like Twitter stuff. It's like someone finally finds the holy grail, right? Oh no, we've been charged for something we didn't realize.
Right. Yeah. Well, that segues perfectly into our next story, which is about the CFPB and their attack on surprise charges. And there's two things there that they were focused on in the news this week. One was what's surprise overdraft fees, and that is an overdraft fee where the debit card transaction is initially approved because you had the money in the account, and then when it goes to settle, typically 2 days later, there isn't enough money in the account. So that's and that's something that they've had. There was a deal with Regions Bank where they had the Regions Bank sort of settled with the CFPB on this very issue. There's that, and then there is the depositor fees, which is when you go to deposit and I hate this idea. I hate this fee. It should be should be banned because you go to deposit a check that bounces through no fault of your own, and you get charged a fee, which that's so those are the two fees that they've been hitting on right now, and I think they're both. I mean, they're both fees that are pretty unpopular, that's for sure. This is again Rohit Chopra he's bringing down the hammer, and banks had better beware.
That fee of basically the bank chooses which one is the right order in which to settle into your account, and essentially gives them the ability of, oh, this transaction was last, actually, not this one. It's like criminal.
Well, I don't know if that's even happening anymore. I mean, I thought they had.
Do we know that that's not happening anymore? I mean,
actually, I don't know.
Say if you go to a restaurant and you pay $50 and there's a $10 tip, and that brings you close, but obviously that $10 tip's not on there yet because the restaurant probably didn't settle.
Right.
And so you're assuming I have the money in my account, and you overdraft like $5 or something like that. Mm-hmm. Like, that type of stuff happens all the time. There's, in this case, I'll agree with the CFPB. There's a lot of times I don't. But there's got to be a simpler way to understand some of these mechanics, and the
Yeah.
banks just to be a bit more transparent. I'm sure people, if they were transparent and knew the transactions, maybe they just wouldn't spend that extra money and be like, all right, I'm too close. But
Yeah.
it still feels like they're pulling stuff over people's eyes.
It's also just like, it just shows you how broken the back end is for so many of these systems, right? Like if we were able to do basic account like validation and just check like live, right? Like is the money in the account? Like at different points in the system, you would have very simple, not very simple, there probably would still be some dispute management, but it would be much more straightforward.
Right.
That having this problem even exist in the first place.
And this problem is going away. I mean, there's no question
Yeah.
in my mind. We're going to real-time payments, whether it's FedNow, whether it's some sort of
Right.
tokenization of deposits or a stable coin. By the end of the decade, we will not have this issue because
but small community banks still might. There's no way that you think all small community banks will be into real-time payments in the next 10 years.
Yes, I do.
Okay. I'm not as optimistic.
Oh, I think they're going to be forced to. They're going to be forced to. I believe, because they don't want to be left completely behind where everyone else is doing real time. You go to this bank and everything takes 2 days.
No, there's going to be a big gap. It's like the top, 250 and everyone else that's like slowly getting to the system, but they're not there yet. And I think that's going to expose something over time. I mean, Peter, you did that one podcast with, I forget his name, Aaron Levine, who said that the banks that make the most on fees are the smallest banks.
Right.
And it's basically all their profit is fees.
Yeah.
Though Chase has 12 billion in fees, it's 1% of their profit or something like that. And all those banks have really bad old technology and they don't have the capital to just invest.
Mm-hmm. Yeah. Well, I was just at a community bank conference today in Nashville, and there lots of fairly small banks, and everyone is fully
I hope so.
Fully aware. I mean, there'll be some outliers. There's before. We got 7 years till the end of the decade. I think if
that's the case, that would be infinitely fantastic for the consumer and small businesses overall.
Yeah.
Agreed.
Okay. Well, let's move on. We're going to talk about Brex. Brex was in the news a lot. We covered this story when it came out, when they basically said goodbye to their small business clients, and Brex co-founder Enrique Dubugras has been pretty silent since then. But there was an article in TechCrunch this week that first time he's actually come out and explained his reasoning. And when you actually read it, it makes sense what he was talking about, because they were focused on fast-growing startups, and some of his startups that have been with him at the start are now more enterprise-type companies. And then they've sort of added the small business piece. Not necessarily fast-growing small businesses at all, just small businesses. And then now they said that there's too many of them, and so we can't really do startups and that become enterprise-type companies and just these small businesses that don't really grow. We can't do both, so they basically nixed the small business. It was still done. He didn't. I mean, I would have liked the interview to have sort of said, well, don't you think you could have handled it better? And but they didn't. He didn't actually go there. So still, it was definitely a black mark on Brex. But I now understand his reasoning, which is good. TechCrunch had the piece.
Right. I find this a fascinating topic because I think it shows a few things. I think one, it shows that the fintech market in general and the startup market is growing to substantial scale. Right. The fact that a company of that size can say, no, you know what, this is our focus, this is our swim lane, just shows you that is a big market and we've evolved a lot. I think part two is it just shows you that you have to focus on core verticals. I think one of my takeaways from Money 2020 last week, or whenever the heck that was, time's been a vortex, but we're seeing even within categories like banking as a service, and one that's just got so muddled around who does what and how many features do you have and who's got feature parity. You're starting to see those swim lanes emerge, right? Like verticalized champions at different things, whether it's sort of issuing credit cards, whether it's focusing on the bank account side, whether it's the ledgers, whatever it is. And I go back to that point. I think the market's getting big enough now where you can really build multi-billion-dollar assets in these spaces. And you, as a founder, you can do that. And then part 3, which I think is really, really, really critical, is that you have to build software that's actually useful for the workflow of your end user. You can't generalize across everyone forever, right? Whether that's a small business that's built like a coffee shop, or whether that's a tech startup, those are just different companies. And I think that's where we're starting to see this evolution of software fees attached to this spend management category starting to be a bit more okay. It's like people see value in the workflow. They see value in the product, not just in sort of the card itself,
Right.
which is important. And I think is why we'll see cool companies like the ones taking on Wex and FleetCor and all the stuff that's starting to emerge, where it's about the workflow software as well.
Mm-hmm. Mm-hmm. Okay, let's move on. We've got 2 more stories here to cover. I want to talk about the article in the Financial Brand, talking about banking apps for kids. One of my favorite topics, because we're sort of into that in our household. RBC, Royal Bank of Canada, has launched an app called MyDo, which is a banking app for kids, and it's making it available to other banks as well. So it's not just for RBC customers, which I thought was interesting. They've also got they've got a kids edition, 6 to 14, and then a sort of a student edition with all the teenagers and college students. And then Go Henry, which was in this article as well. They're obviously the UK companies opened up here in the US, I think, last year. And they are partnering with banks. They're going to be offering theirs to multiple banks. So the thing is, these banks most banks don't have an app for kids. And if you want to get them in early, then you need to have an offering. And so I think this is a market that it's nascent, and I think it's going to get a lot bigger over the next couple of years.
I mean, I have young kids. Anything to help young kids get into financial services earlier is better. I mean, I was lucky. Our parents, taught us stuff, pretty early age. But most people, there's a huge gap between when you grow up to when you start needing to learn about financial services. Most of the time is when they throw a student loan at you.
Mm-hmm.
And anything to help that process get a lot earlier is better. And that's what this is trying to do.
Mm-hmm.
It's also just going to build really interesting credit data and data around consumers over time across the world, right? Like I moved here from Ireland, and when the first day I got to university, they walked 50 international kids straight into an unnamed bank, a card that I still have, right? And I was like, someone hopefully got paid for that, because if not, that was a lost opportunity for someone.
Right.
But like, there's just the stickiness is still there. And I mean, this goes back to the same sort of theme that you see with like the promises of the Lemonades of the world. Oh, we're going to start with renters and we're going to get them for life insurance. If your business model doesn't work at the beginning, it's going to be tough to keep them for decades until they need life insurance or home insurance. But at least with this kid space, I think it's the parents are the target. And Todd, I don't know how you feel about this, but like, you'd pay a couple of bucks a month to make sure that there are good controls, good privacy, good things set up to make sure that your kids learn and aren't like doing things that they shouldn't be doing, right?
Yeah.
So I think you can make the business model work without needing to just have kids go out and spend hundreds of dollars a month to earn interchange fees and then have misalignment of the whole point of the app in the first place.
Right.
Yeah, exactly.
So it's an interesting category. I think it's a really good one too.
Yeah. Yeah. Okay, we're going to close with Plaid, and they reached their 3rd annual Fintech Effect report this week. Fintech adoption has actually dropped overall in 2022 over 2021, because there was a huge bump 2020 and 2021 for the pandemic. And then some people have gone back to in person, just a small drop, but it's still overall way up from 2019. Interestingly, they said like in younger people, it's not down, it's actually up still. They say that one of the things they said was that 83% of consumers in the US want to be able to control the data access around their financial information, which is probably not that surprising. And yeah, I mean, we wrote, I think it was, this is on Fintech Nexus website. You can go and read the article. There's a lot of good stuff in there.
I'm not sure I'm convinced about the 83%. I don't know. Every time I feel like, we cover something related to switching and stuff like that, like we never see people switching accounts to a high degree. And I don't know. I feel like people
It's just
will
more about
would-
control, not
people would
then-
answer the question like that, but when given the control, I think they
Yeah.
would
Yeah.
gladly have an institution do it for them.
Right, quite possible.
Yeah. The other thing was just like the online only banking services, the numbers, whether those numbers are inflated or not, they're still small. It just shows how much room there is still in this market to help people with like just bring things to the digital world. So view that as a good opportunity for us all here in this industry.
Yeah. Okay, well that is our time for today. Thank you, Andrew. Thank you always, as Todd. Before we say goodbye, though, a reminder: if you're even moderately interested in Latin American fintech, and let's face it, it is one of the hottest regions on the planet right now, you need to come to Miami in December 13th and 14th. Fintech Nexus LATAM, all the big names in Latin American fintech will be there. Todd and I will be there. And it will be a great couple of days on the beach in Miami. So with that, we'll wish you a good afternoon and have a great weekend. And we'll be back same time next week. Thanks again, Andrew. Thanks, Todd.
Thanks, Andrew.
Cheers.